All right, welcome back to the next video. And in this video, we're going to talk about the proven recipe for double-digit returns in apartment investing. So I'm going to dive into these topics, why earning double-digit returns is critical for your financial freedom. I'm going to break that down. I'm going to show you why if you're only getting single-digit returns, it's just you're never going to get where you want to be financially. You're never going to get the financial freedom and that time freedom you're looking for. And I'm going to give you a simple formula to double your money in 5 years or less. And we're going to look at some key factors such as the market, property types, and your investment strategies. I'm going to start off with the rule of 72. And if you've never heard that, what you would do is you would take your annual rate of return, you would divide that by the number 72, and that's how many years it's going to take to double your money. So if you have a money market account or something like that that's giving you a 0.25% return, in order for you to double that money, you'll see here that's 288 years to double your money. Well, I'm just not interested in that at all. And then maybe you're getting, look at your savings account, which maybe you're getting a 3% return. If you got your money just sitting in another low yield account and you're like 3%, it's going to take you 24 years to double that money. Whereas now you'd start looking at something more like the stock market, and when it's performing very well, maybe you can get a 10% average return there. Well, that's still going to take you 7.2 years. It's going to take you a little over 7 years to double your money. That's just a very slow burn to be able to grow your wealth. And what we're looking for is a wealth accelerator. And that's why we're looking at apartments. And that's why we talk about these double-digit annual average return. So if you can get a 20% return on your investment, then you can basically double your money every 3.5 years. And so let's break that down, what that would look like and the different ways you can invest in apartments. So you have two different ways that you can invest in apartments, and there's no right or wrong way here. Both of them are fantastic ways to accelerate your wealth creation. It just kind of depends on if you want to be all in on apartment investing or if you just want to take advantage of the investment vehicle. So let me go ahead and break that down. There's two types of investors here in apartment investing. And one is a passive investor. And let's say you invest $50,000, you could double it every 5 years because we target average returns, 20%, average annualized returns of 20%. And so every 3.5 to 5 years, you'd be able to double your money. That's actually fantastic as a passive investor. And you don't have to do any of the work. It's purely passive, and you get tax advantages along the way as well. Or you can be a deal sponsor, and that means you're going out, you're finding the deals, you're meeting with brokers, you're underwriting the deals, you're submitting the offers, you're raising the capital, you're doing the asset management, everything that comes along with it. There is work. Now, we talked about in the last video, it's not nearly as intense in single family homes, but there is still a lot of work that has to be done. So because of that, you get compensated differently than if you're just a passive investor. And if you are a general partner or a deal sponsor, your potential for returns are about 80 to 100% annually or higher. It's a lot larger. But once again, there is effort and time and energy that goes into that. So you need to make the right decision for you specifically. I'm going to show you a side-by-side comparison of if you were to be a deal sponsor or a passive investor in a deal. So on this particular example, I'm using a $10 million deal. I'm using an 80-20 LP versus GP split with an investment of $50,000. So what that means is it's a $10 million deal that the limited partners own 80% of the deal and the general partners own 20% of the deal. It's a very common split. It's either 80-20 or 70-30. And both the passive investor or the general partner would invest $50,000. So here you've got a column showing you what the passive investor or the limited partner gets over the life of the deal. And then you've got the deal sponsor, the general partner, and what they would get over the life of the deal. So I'll break these down and then you can just see here. I mean, if you look really quick, if you were to invest $50,000 as a passive investor in a deal, over the course of 5 years, you would get your $50,000 back, plus you would make $40,000. So it's $90,000 back to you. So you can see if you put in 50, you got $40,000 back over the course of 5 years. You're nearly doubling your money within that 5 years. or if you're a deal sponsor, there's a whole lot more cash that comes to you. Now, typically on these deals, there are multiple partners, so the amount of money that's here is generally does not go to just one person. It is split up amongst those partners equitably. But let me show you here. So when you acquire these deals, we have what's called an acquisition fee. And the acquisition fee is because you spend a lot of time and effort, energy, even finding the deal. You've got to secure the deal. You're putting hard money down on the deal. You're finding the attorneys, you're working with the lenders and all of that stuff. So there is time and effort, energy you put into that. And because of that, you get an acquisition fee. Then I mentioned this before, you get cash flow on these deals, and we're doing this based on average 10% cash on cash returns. And typically these deals will be somewhere between 5 and 10%, but just for easy numbers, we're doing the 10% here. So it'll be about $4,000 per year. And then you have a GP split. So this, the 20% goes to the general partners. It's the ownership based on the total cash returns of this, the $300,000. That would be $60,000 a year just for being a general partner, and your portion of that, and the just the 20% there. And then you have the asset management fee. So we also charge a fee for the asset management. While we do have property management who's heavily involved, we have to manage the property management. As things come up, who does the property management come to if they need guidance and direction? It's us as the general partners. We ultimately are the owners. We're responsible for all this capital that we've raised. We want to make everything to the best of our ability, the best returns for all of our investors. So because of that, we do get an asset management fee. Then at the end of the 5 years, we talked about this before, there's a capital gain event. So you have $20,000 for the gain or the sales proceeds. And then you have the gain. This is just the LP split, and this is basically the gain from the 20% of the GP split. So it's another $300,000. So your total returns here, as I mentioned before, you can invest passively and make really good money. I've done it myself. Not only am I'm in multiple deals as a general partner, I'm actively an LP. I should say I'm an LP, a limited partner in 2 deals right now. And one, I'm actually using a self-directed IRA. So I'm using my retirement funds to invest in a deal. Plus I've got cash invested in another deal. So I invest not only in my own deals, but I also invest in other people's deals because it's just such a great wealth accelerator. But hopefully this gives you a really good breakdown of what the overall returns would look like once you start investing, whether you're a passive investor or a general partner. From that, let's talk about what types of properties to buy. There's a whole bunch of different properties out there, and if you don't know all of them, don't worry, I'll give you a high-level overview. But where you want to focus is on B class and C class properties. So in the world of apartment investing, you have A, B, C, and D. Think of D as rundown slumlord type of a thing. Maybe I shouldn't call it slumlords, but they're generally really rundown properties. They're not in good shape. Those are D class properties. You can make a lot of money there, but they're very tough. It's an uphill battle. And then A class, those are brand new properties, brand new apartments. Those are A class buildings. Typically you see very small cash flow on those. And a lot of times when you buy those deals, you have to focus on either building the property, and so there's no cash flow while you're building. But then even once it's built, you have to fill the property up. So it's a very long time until you get cash flow on A class properties. Or if they're already filled up, there's generally less margins or just a more sought after property. Less maintenance and overhead, but the other thing that happens is anytime there's a recession, you get people move out of A class, and where do they move? They're going to move into the B class. And where does the B class move? They move into the C class. So the B and C class properties, it's a very good working class property. You tend to find the highest occupancies in the B and C class properties, and it also gives you room to raise rent as you're improving the properties. So focus on B and C class properties. I like to focus specifically on properties that are built in the 70s through the 90s, maybe the early 2000s. I don't like to go a whole lot older than that. There's a few reasons. You end up with cast iron plumbing, which you don't want to mess with if you don't have to. You want PVC in the buildings. You also don't want to deal with aluminum wiring if you don't have to. And that's in a lot of the 60s buildings. And then if I can avoid it, boilers and chillers. Now, it's not the end of the world, but individual HVAC units just generally are a lot easier to manage rather than having to deal with boilers and chillers. So that's why I say between the 1970s, 1990s, they don't build B and C class properties; they build A class properties. So you're looking for something that's a used property where you can focus on value add. The idea here is that you want to go in and know you can make improvements to a property that you can see specifically in the sub market with a proven business plan. And that's how you can force the value, force the appreciation in these properties. That's a key concept here, is the value add. So just wrap that up. The B and C class cater to the middle class, working class demographic, and you can do A class. I know people that have done it. I haven't, but it's just because they're generally lower returns there. So now I'm going to focus again on the value add portion here. What you want ideally is a stabilized property, meaning you're not looking for something that's 40-50% occupied and you're going to try to fill it up. I've seen that work. I know people that do it, but especially when you're first starting out, you want a stabilized property. Even if it's in the 80% occupancy, that would be okay. But where you can focus on some occupancy and increase the income that way. But if you can then improve the overall property, you're doing renovations. I got a bunch of units that hasn't been renovated in 20 years. Then you can renovate those units, and you can upgrade the common areas. You can put in. I've seen little like water parks put in, little play areas put in. I've seen little soccer fields put in. Those are some of the common areas that you improve, and then you improve the units themselves. You just make them nice for the residents that are there. And then once you do those things, you're able to raise the rents, and then you focus on optimizing the expenses. And you'll see this last bullet here is target properties where income already covers debt. And there's a little bit more of an advanced topic, but when it comes to financing, the lenders very specifically, they have a ratio called the debt service coverage ratio, and they will look for properties where there's already enough income at the property to cover the debt without any major issues. Otherwise, you got to go into a different debt structure. You can do it, but you want to target properties where the income already covers the debt. You're going to be way better off. Now, the next thing I want to do is I want to talk about market selection. So here is the main criteria for what markets to even pick. You're going to look for landlord and business friendly states where you have low to median housing cost, and we have high population and high job growth. And what that means is you get a combination of, if it's business friendly, you're going to have jobs being created there, and that means you're going to have people moving there, and you're going to have job growth there. So when there's a recession in the market, if it's a high job growth area, you're much more resistant to those issues with the market. And then the medium housing cost is what that does is, if it's a really, really expensive place, yes, you're going to have apartments available, but the apartments are going to be very expensive. But you're looking for an above average affordability gap. So for example, on average, the cost of paying mortgage versus paying rent right now across the United States is about $1,200. And that's an affordability gap. And what's happened is a lot of people now are not able to buy a home, but they can rent. So you find those areas where you have the above average affordability gap. You've got business friendly, landlord friendly, and high population and job growth. So at a high level, what are some of those markets and what would they look like? That's going to be Texas, Florida, Georgia, Colorado, Ohio, Oklahoma. I have those listed here. Arizona is another good one. The Carolinas, South Carolina is another good one. But the Sun Belt states, all those areas in there, they're high growth areas. And so those would be areas, if you don't already have a market selected, that would work well. Now, just because I mentioned those areas does not mean you can't invest in your own backyard. Absolutely invest in your local area. if it meets the criteria. That might be a really good place for you to invest. And I know people from all over the United States who invest in their backyard and they do very well. If you want to do that, great. If you have partners who are someplace else, then that's also great too. For example, I live in California. I don't invest here. Everything I invest in right now is in Texas, just because I have partners that are there, they're boots on the ground, and I'm able to leverage other people's time, and I bring value in my own way, they bring value in their own way, so that works. But if you live in an area that you feel is landlord and business friendly, there's a above average affordability gap, and there's strong market growth, then consider that, and I'll tell you, even though I live in California, the particular region I live in, there is high job growth, there is high population growth, there is an above average affordability gap. So there's a lot of factors that actually make it appealing here. So investing in my own backyard is becoming more and more appealing as I'm looking across the United States, and maybe leveraging some of my own resources here. So absolutely, you can invest in your own backyard if it makes sense. You do not have to invest out of state. It just depends on where you're at and what your team's going to look like there for you. Now we've mentioned this, but when you're doing this, the benefits of multifamily investing, you get consistent double-digit returns, even in fluctuating markets. And I mentioned, why we look at those specific areas so that we can ensure even in down markets we're getting those types of returns. You get much higher returns than almost all other asset classes, and you have a lot lower risk because it's housing. And we get to leverage professionally managed properties and other people's money. So there's just so many factors that keep stacking up. It makes it such a valuable asset class. So with that, basically, follow this formula that I'm teaching you, this recipe that I'm teaching you, and it's going to help you start targeting these properties of where to invest, lower that risk, and get that, above average return, the double digit returns, so that you can double your money, every 3.5 to 5 years. That's how you're going to accelerate your wealth. Invest in B and C class properties in growing markets. And in the next video, I'm going to share with you 9 key lessons for success that I've learned over the years in apartment investing. So with that, I'll see you in the next video.